Okay, so here we are starting with the easiest of all the topic, right? Now you will see me saying that for every topic, by the way. It's financial statement analysis. Okay. Now this topic has a weightage of around 11 to 14 percentage. So on an average, you'll see 20, 25 questions in the exam. Recently, one of the mocks I saw, they had 20, 22 questions, I think. So the number of questions are enough. And even though FSA also has so many readings, you have 12 readings in FSA. But to be honest enough, the quantum of FSA has been substantially reduced from the previous years when I used to teach FSA. So relatively, FSA, even though you might be struggling, but FSA is relatively much leaner. It's like FSA has done a lot of workout and shredded its body. That's how FSA is. Now, most of the students are worried about FSA because they think it's plenty of information, IFRS, US GAAP, so much of confusion. EPS calculation, I'm sure many people struggle with EPS calculation. They are lengthy and all. Except two or three questions, EPS, impairment, and so on, except that, or DTA, DTL. Apart from that, FSA is pretty much normal. FSA, it's not difficult to score 70 percentage or 70 percentile in FSA. And that you will realize when we go through the syllabus. Okay. So the 12 readings that you see the index from my book, right? These are the 12 readings. I've put the questions also in the same flow. We'll begin with the introduction. Then we will move to EPS calculation. I've put a couple of examples. You will see the variety of those examples, and these are something that you should expect in exam. So we will do EPS calculation, very important, and then proceed ahead with all the topics. Okay, let's start with FSA's first introduction to financial statements. Now, if you see the first question, ratios are an input into which step of financial statement analysis? By the way, there are 6 steps of financial statement analysis. Do you remember which steps? It's state the objective, then gather the information from the 10K report, then process the information, correct? Then analyze, then make a report, conclusions, and update the analysis. So there are 6 steps, out of which they are saying ratios are input into which of the financial statements? Now, can you answer everyone? A, B, C, A, B, C. Okay, so see, this is very interesting. Uh, Most of the times people will, yes, everyone, I want everyone to answer in the group. Okay, everyone should answer. Everyone should answer. Okay. Now see, there is a mix of answer A or C, right? See, ideally, ratios are input. Ratios are input in which step? In analyzing. When you analyze the information, you require ratio as an input. But some students have a problem, sir. Isn't it processing the data? Yes, in processing, ratio is calculated. But remember, in processing, ratios are output. They are the final conclusion. So here we do calculate ratios in the processing step, which is by the way, step number 3. But in that, it's what? It's an output. The conclusion, the calculation after processing the report, what you get is the ratios. So the output of step number 3 is ratio. They are talking ratio is not as an output. Ratio is input from which in which step ratio is the input in the analysis where you already have the ratio, that is your input, and then you're making conclusions. Got it? Very important. It looks very easy, but important question. Okay. Now, actually related to that, if you would see, of course, you're going to get in question exam, not in the flow, you might get random questions. So actually question number 4 is quite related to the same thing. Which of the following best description of the financial statement analysis framework out of all that they've given you? Which is the first step? First step is gathering the data. No, the first step is objective. You should know the objective of why you want to do FSA, right? So that is state the objective, that is only in option B. Correct. Then comes gather the data. Third is processing the data where you calculate the ratio. Fourth is analyzing and interpreting the data. And fifth is where you do the report. But that's where your job is not done. You have to constantly update. So the answer is B, B, B. Everyone right? Right? Correct? Now let's go to question number 2. Let me see how much your information is accurate. Okay. Everyone has to answer this. I should not say that again. Everyone has to proactively answer. Information about management and director compensation is most likely found in audit report, proxy statement, or earnings release. Yes, check, check, check. Everyone? Yep. Yes. Under which report, everyone? Director's compensation, everyone. ABC, ABC, ABC. Yes, yes. Audit report, proxy statement, earnings release, everyone. Yes, it's in proxy statement. Remember, proxy statement is where the voting happens. Can someone tell me which form it is? Which form it is? It is DF14. Remember DF14A, DF14A, DF14A. This is the form where you require shareholder vote or proxy voting. So DF14A is proxy statement. Understood? Next, according to IFRS guidance for management's commentary addressing the company's key relationship is C. First of all, IFRS guidance that what the management commentary must have. Is it compulsory? What exactly should be there in the commentary? No. See, footnotes or disclosure is not recommended, it's required. But commentary recommended. It's not a requirement. Got it? Also, one more thing, additional information, management discussion and analysis is not always audited, but footnotes are audited. Clear? Fourth, we've done. Fifth one. Under IFRS, a loss from destruction of property in fire would most likely be classified as, guys, here IFRS or US GAAP is not an important thing, but loss from destruction of property, would it be classified as continuing, discontinued, or OCI? Yes, everyone. Continuing operation, everyone. Okay, guys. In OCI, there are only four items. Unrealized gain and loss from hedging derivatives, unrealized gain and loss from FVOCI, fair value, other comprehensive income, changes in assumption of pensions, right? And foreign currency translation gain loss. Only four items in OCI. So this is not a part of OCI. B, discontinued operation. Discontinued operation is only when the unit is no more going to be existing in the future. Here, there is a of the loss due to the fire, but we haven't shut down the operation. So it's not neither discontinued nor OCI. It is a part of continuing operation. Understood? Very important question. Most of you all got wrong. Four things in OCI. You should remember all the four things. Foreign currency translation gain loss, unrealized gain and loss in hedging derivatives or FEOCI. And the fourth is changes in pension assumptions. These four items are in OCI. They are not in your notes. If you're referring notes, they are not in the notes. They are in the prerequisite. Understood? All of this is not in the notes, but in my book, I've kept it because it's not in if you're referring latest Schwezer, it's not mentioned there. So four items of OCI. Yeah, go ahead.
So in the question, when the question hasn't mentioned whether it is going to be whether the operation is going to continue or not. So how are we going to figure it out that it's
But
going
how
to
will I?
continue?
But they haven't mentioned that. See, it's a property. Discontinued operation, you need to understand let's say it's a business unit or a branch that you are not going to continue from next year. They are not talking anything about that. They are just talking that the property had some fire issue. Got it? So you can't assume that property is a different business altogether and it is not going to be operated. That's a lot to assume.
Okay.
For me
Okay.
to, for them to, they should tell me, right? There is a business unit and it is not going to continue. Having a fire or any accident does not mean I'm going to stop doing business there, right? Correct? So
Yes, sir. Got
as
it.
part of my routine operations. Now, the choice that they give discontinued only when you're not going to continue that line of business or that particular branch or that particular department that you're not going to be continuing from next year. Then it has to be below the line. Got it? OCI, I already told you four items in OCI. Understood? Right. Again,
Yes,
I'll
sir.
repeat. See, again, I'll tell you something about FSA. In FSA, Schwezer is not appropriate. If you are following Kaplan Schwezer, the flow is not appropriate. Okay. I can tell you from my experience. If you go to the CFA Institute notes, it will take you probably an entire year to complete just FSA. So I'm not exaggerating or pushing my notes here, but I'm just saying out of the experience and students and understanding the flow of FSA, this is how I framed. So all these small components are not there in the book, but I do it. Got it? That's why most of the people are not aware about OCI. Also, trust me, most of you all have studied finance or accounts in your university in India or wherever you're from. The problem is that we have never been taught about OCI. I was in one of the most reputed colleges in India. I never saw something like OCI. So I can just imagine none of us knew about what is OCI before doing CFA, I'm sure. Of course, if you must have done any other qualification, you must be aware. But I was not aware about there is something like OCI also before doing CFA. Imagine. Got it? So I'm sure you all must have also faced the same thing. Thank you for your my notes. Thank you so much. Okay, let's go with the next one. For 2009, KRD Products, this very famous company, has a net income of USD 1 million. In January in 2009, there were 1 million shares outstanding. This is where comes my favorite thing, EPS, earnings per share. On July 1st, company issued 100,000 new shares at 20 per share. Company paid USD 200,000 dividends to common shareholders. What is my basic EPS? I'm just going directly with the formula of basic EPS. Basic EPS is net income minus preferred dividend over weighted average shares outstanding. Net income is 1 million here, everyone. Correct, correct. Do I have preferred dividend? No, they've given me common dividend. Do I deduct common dividend? Common dividend? Common dividend, we don't subtract. Got it? So there's nothing going to be deducted from the numerator, 1 million only. Denominator, I already had 1 million share at the beginning, but then I issued 100,000 more shares on 1st July. So they were available for 6 months. So 100,000 is 0.1 million for 6 months. Understood? That's going to be my basic EPS. Sorry. So my basic EPS formula 1 divided by 1.05. You should get the answer. Let me know. Check, check, check. Those who are not answering, I will just put them out from the group. Yeah, Y is not the answer. The answer is either A, B, or C. There is no Y as an answer. Okay. Everyone got it? 0.95. Easy, 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 easy. You all should thank God that you all are not in my live class. In live class, those who don't answer, I tell them goodbye. Go back home. Everyone got it? C? Perfect, perfect. Next. For fiscal year end, KRD Corporation reported net income 200 million and weighted average of 50 million shares. There are 2 million convertible preferred shares outstanding, paying an annual dividend of US dollar 5. Now, this 5 would be definitely per share. Am I correct? Right? Each preferred share is convertible into 2 shares of common stock, the diluted EPS. Now, guys, let me tell you, whenever they give you diluted EPS, what is your first job? Are you directly going to calculate diluted EPS? Tell me, are you directly going to calculate diluted EPS? No, you always have to calculate the basic EPS first. Correct? So let's do the basic EPS. Everyone with me? Basic EPS. How many I have here? Reported net income of 200 million and weighted average shares I have 50. So 200 million minus preferred dividend will do. Weighted average share is 50. Preferred dividend, annual dividend of 5. And I have 2 million preferred shares. So 2 million into 5 will be 10 million. Am I correct? That is going to be my dividend. Isn't it? Isn't it? Preferred dividend. Correct. So let's finish first. What is going to be the basic EPS? Because this is all we require. So 190 divide by 50. My basic EPS is 3.8. Correct? Now let's look at the diluted EPS. In case of diluted EPS, I will again do the same thing, 200 minus 10 divided by weighted average. This is my technique. First, whenever they say diluted EPS, you first put all the inputs of basic EPS, then make your life easy. Are the preferred share convertible? Yes, they are convertible. So add back the preferred dividend and add extra share, 2 share of common stock. So every preferred shareholder will get 2 shares. How many? I had preferred shares 2 million. So additional 4 million. So 200 divided by 54. You should get 3.70. Everyone in the class, 3.70. Check, 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 check. Is it below the basic? Yes. Then you have the permission to go ahead and select. That is very important. It should not be above the basic. Otherwise, it is anti-dilutive. Okay. Everyone, check. Perfect. Clear till this point? Okay.
Excuse me, sir.
Yes, go ahead.
So what if we don't solve basic EPS and then
Then God bless you.
then
Simple.
okay.
God will be there to bless you. Don't do that mistake. You're not doing mathematics. Basic EPS, you have to check. Got it? All the other assumptions I have seen many students telling me, oh, the diluted is always the below the basic, right? I have a student who told me that why should I calculate diluted? Whatever is the basic EPS, I will just see whichever is the below one. So all these strategies, don't do it. Okay. Process is important. Do the basic, then calculate the diluted, even if they ask you diluted. You will see why once you realize it, because there you have to be ready for all the types of questions. Also, since you know me from watching my videos and all, let me tell you that we don't change our methods for different variety. We keep the process same. Let them twist anything. So my process is clear. If you want to make EPS easy, basic, and then diluted. Okay. However
So,
easy, difficult it is. That will make sure that.
so
Go ahead.
yes, sir. So while we were calculating diluted EPS, if you would have got 3.9, then it is an anti-dilutive EPS.
Yeah,
In
you'll
that
see
case,
that.
which option?
You'll see that. That's what
Yeah.
I said. You need to hear it. What did I say? It should be below basic EPS. If not, then you have the notes with you. I've put up in the notes that then you cannot use that. The meaning diluted, the English translation of diluted is that it should be below. If it is above, you cannot use that. You have to use the basic EPS only. Got it?
Yes,
Yes.
sir.
Perfect. Yes. There's much more deeper discussion why to do that. I don't want to waste everyone's time because see, what happens is that if I use more time, students are like, oh, when will you finish it? When will you finish it? This is what happens in a live batch. So I don't want to drift with the discussion, but see, accounting standards want you to use conservative approach. So if the EPS is going to fall, you need to inform the investors. But if the EPS is going to rise, you should not. So that's a conservative approach. That's why we use diluted EPS. Got it? Anti-dilutive, we don't need to. Okay.
Hmm. Yes.
Perfect. Yes. Okay. Let's go with the eighth one. For fiscal year ended, company reported net income of USD 2 million and a weighted average 2 million. So what I do is that how do you save time? Of course, time is not an issue in level one, but just to tell you, sometimes students spend unnecessary time. So here, follow with me. What I do is that I know they have asked me diluted EPS. So again, I am going to do basic EPS. So net income is 12 million. Okay. Divided by common stock is 2 million, right? The company paid 800,000 in preferred dividend. So minus 8, right? And then had 100,000 options outstanding at an average price. So this is about stock options. So this is about options. Average price is 20. Market price of the company, CAD is market price over the year. Exercise price is 20. Sorry, exercise price is 20. Average market price is 25. We'll discuss about the option later. Diluted EPS. Now, for calculating basic EPS, I don't need this option related information. So all I'm going to do here, is conclude my basic EPS first. That is 12 minus 8. 4 divided by 2 is 2. I've made a mistake. What? It is 800,000. And this, I deliberately did it because you might also make up a mistake. 12 million and 800,000 is 0.8 million. Got it? So 11.2 divided by 12. Your basic EPS is 5.6. Okay. Now going back to diluted EPS. Diluted EPS, I again put the same information, 12 minus 0.8 over 2. But then whatever is extra, I will put that. Extra, the preferred shares, they are not convertible. So you don't need to add it back. What you need to do rest is you need to discuss about the options. Now, if you are not aware about the treasury stock method, this will be difficult for you. I would recommend you to go back and see the treasury stock method process. In treasury stock method, we first need to check whether the option is exercisable or not. Exercise price is 20, market price is 25. So the option holder will exercise because it's cheaper. So if exercised, how many new shares will be issued? I'll write down here. Additional shares will be issued is how many, guys? 100,000 new shares will be issued, but how many shares will be repurchased? Now for this, I want you to focus and understand how many new shares will be repurchased, guys. That depends on how much money the company will get, right? Correct? So see, what is going to be the case? How many shares will be issued? 100,000 options, so 100,000 shares will be issued. How many will be repurchased? Those 100,000 at the rate of 20 will be subscribed, and the company can go back and repurchase at 25, the market price. So 100,000 into 20 divided by 25, that is 80,000 can be repurchased. So the net shares outstanding, 100,000 will be issued, 80,000 will be repurchased. So basically, how many net issued? Only 20,000. So 20,000 is basically 2.02 million. Okay. Not 20, 200,000 is 0.2 million. 20,000 is 0.02 million. Isn't it? So my answer will be, you can put the entire number also. Okay. If you're confused with zero, I have a habit, so I use it. You can use the entire number also. So 12 minus 0.8, that is 11.2, divided by 2.02 million, you will get 5.5446, or simply said 5.54. Your answer is B, B, B. And you need to check, is it below basic? Yes. Got it? Everyone, check. Someone has written 5.6. It has to be 5.54, not 5.6. You can't round off 5.54 to 5.6. If it is 5.55, you can round off. Got it? Clear? Okay. Next. Analyst has gathered the following information. Net income is provided to me when they have convertible preferred stock. Okay. And convertible preferred stock, and they have also convertible bonds. Both are there. For bonds, I need the tax rate also. So first, we will calculate the basic EPS. Someone who's not getting the answer, check out the numbers. Exactly 12 minus 0.8 divided by 2.02. Exactly, you'll get this. Okay. Yes. Coming back to this question, net income. So what is going to be my basic EPS, everyone? My basic EPS is net income 30,000 minus preferred shares dividend. How much is going to be the preferred share dividend? See, check out 5,000 shares, right, of common stock. Okay, so this is common stock, not this. And 500 shares of 8% at 90 par. So what is the preferred stock value? 500 into 90 par, that is 45,000. On that, 8% turns out to be 3,600 is your preferred dividend. Correct? And outstanding shares are 5,000. Are you getting this numbers, everyone? Correct? Now, for basic EPS, I only need this apart from if they have issued any extra share, which they haven't in their information, right? So for basic EPS, my job is done. This minus 30,000 divided by 5,000. I get my basic EPS as 5.28. Are you getting the basic EPS as 5.28? Check, check, check. Right? Now, when they ask me diluted EPS, definitely I'm going to add this information 30,000 minus 3,600 and below is 5,000. But remember, these are convertible preferred stock. So I need to add back the 3,600 after subtracting. Basically, it disappears, right? Now, but whenever there is convertible preferred stock, there will be new shares, isn't it? How many new shares? 500 preferred stock, and they are saying convertible. How many shares? See, last year issued, okay, see bonds convertible into one shares. Have they mentioned how many stocks? 500 shares of 8%, $90 par convertible preferred stock outstanding. Each, yes, each share of convertible preferred can be converted into 4 common stocks. So guys, 500 into 4. 500 into 4. Additional 2,000 stocks. Am I correct? Right? And with convertible debt also there will be new stocks. So first of all, whenever there is convertible debt, remember on the numerator, you add back interest 1 minus T, because that is not deducted from, that is deducted from the net income. So you need to add back interest. But remember, interest is always 1 minus T. So what is the interest here? 60,000 is the face value of convertible at 6%. So 60,000 into 6%, that is 33,600. But you need to do 1 minus T. Tax is 40%, so you need to do 1 minus T, that is 60%. So 3,600 into 0.6. Are you getting 2160? Yes or no? Interest 1 minus T. Check, check, check. Let me know. Are you getting this 2160? I'll repeat, 60,000 into 6% into 0.6 after tax. Clear? But convertible shares, you will get additional shares. How many? So they are saying each of the 60 bonds convertible into 110 shares. So guys, 60 bonds and each will be given 110 shares. So 60 into 110, that translates into 6,600 of additional shares. So now if you calculate the numerator, 30,000 plus 2160, that is 32,160. Store 1 on the numerator. Denominator, 5,000, 7,000 plus 6,600, that is 13,600. Store 2. Recall 1, divide by recall 2. I've got my answer. Let me know what's your answer. Check, 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 check. I'm sure you should get 2.3647 if you go for 4 decimal. 2.3647. Are you getting this answer? Everyone in the class, check, check, check. Okay, the objective of this question set that we are doing is for you to realize that, okay, if I'm not getting the answer, I need to go back and revise and practice more. Understood? Clear? All right. Yes, again, always, I'm sure, are you checking that the diluted is below the basic? Isn't it? Everyone? That needs to be confirmed, confirm. Okay. Next, again, they are asking for diluted EPS. I've put a couple of questions of diluted EPS. Let me tell you, in exam, there is going to be hardly one question of diluted EPS. This is what I expect. Okay, I cannot say it will be. It's recorded, but I expect, right? Understood? So again, diluted EPS, always naturally you have to do basic EPS. The reason I've put many questions about diluted EPS and putting so many different varieties is for you to get all the view. Okay, net income 460,000. I need 460,000 net income. I need preferred dividend if I get so, and divided by weighted average shares, right? So 2.3 million shares outstanding. Now 2.3 million, see, you can put everything in thousands also. So I prefer to do this 460,000 and 2.3 million. This is my way. You can put the whole numbers. This is 2,300,000. Okay. 2.3 million. I put it this way. And since they were from 1st Jan, I'll put the whole shares, right? Average market price, this is for stock option. So we will see whether it is exercisable or not. Average market price was 2 and year-end price. Do we take year-end price? No, we only take average market price and we compare it with the exercise price, which they have given later. Don't fall into the trap of taking closing price. You need average market price to be compared with the exercise price. Got it? Understood this issue? Right. Next. I need convertible preferred share. I need to check. Is there a preferred share? 1,000 shares of 8% at $1,000 par value preferred shares. Guys, these are preferred but not convertible. Have they said convertible? No, no, no. So 1,000 shares of 1,000 par, that is 1 million into 8%. So 1 million into 8%, that is 80,000. So minus 80,000. Okay. And then there is warrants, 10,000 warrants, which allows holders to purchase 100 shares at an exercise price. So exercise price is 1.5 and average price was 1.2. Will the warrant be exercised or not? Will the warrant be exercised or not? Check answer. Those who are not answering. Will the warrant be exercised? Yes or not, everyone? Correct. Why? Because the exercise price is lower than the market price, average market price, right? So it will be exercised. But that effect you will see in diluted, not in the basic. In the basic, let me solve my basic. 460 minus 80,000 divided by 2,300. That is 0. I get 0.1652. I have the habit of writing in 4 decimal. You can use 2 decimal also, up to you. Now, for diluted EPS, as I've been doing consistently, I'm sure you all are watching this. I'm again going to put the same numbers, 460 minus 80 over 2,300. This I'm anyways going to put. Now, if they were convertible preferred share, only then I would add back the preferred dividend, otherwise not. Now, the only thing remaining after this is warrant or options. So for that, I need to find the net issue. So how many warrants? 10,000 warrants, and each warrant gives 100 shares. So 10,000 into 100 is 1 million shares will be added. But how many can be repurchased? For that, you need to see 1 million at what price? 1.5 and repurchase at the market price of 2. So when you do 1 into 1.5 divide by 2, basically 0.75 million you can repurchase. So the net issue is 0.25 million. This is treasury stock method. So additional shares, 0.25 million is how much? It is 250,000. Got it? Got it? Got it? That's it. Preferred shares are not convertible, so I don't need to add them back. Okay. So 460 minus 80, that is 380. I store it and divide by 2,300 plus 250, that's store 2. So recall 1 divide by recall 2, I get 0.149. 0.149, the closest is, they've rounded it off. So I will put B. Are you with me? Check. Understood? Clear? I have tried to cover almost all the possible complex varieties that they can. My view is that exam is not that complex, so don't worry. Whatever varieties you need, I've covered here. If you think you need more practice, go back to the notes, see the treasury stock method, practice, and then follow these questions again. Clear? This was from which topic? If you remember, this is from income statement. Then you have balance sheet. In balance sheet, the most important thing that I expect very much to be tested in exam is the 3 types of financial securities. Do you remember the 3 financial securities? Held to maturity, available for sale, held for trading. Correct? right? Okay. Now, if you remember those three securities, I'm not going to go in detail because most of you all have covered into the revision lectures. This is where we are just doing the questions, assuming you know most of the things. So the difference is, how do you recognize the unrealized gain and loss? So I've put the questions in that manner. You can connect it. So for financial assets classified as trading securities, by the way, trading securities is also called in IFRS FVPL, fair value profit loss. Profit loss means income statement. So the reason why it is named is that the unrealized gain and loss are recognized in the income statement. Understood? That's the reason why the name is FVPL. So they are asking the unrealized gain and loss reflected in shareholders' equity. How are unrealized gain and loss? Are they directly put up in shareholders' equity? No, they are not directly put up in the shareholders' equity. They first are recognized in the income statement and then they pass on to the retained earnings. So they are not directly recorded in the retained earnings or OCI. They don't fall in OCI. OCI is only with, I told you, out of the four items, one of the item of OCI was unrealized gain and loss with fair value OCI, FVOCI. FVOCI is also called available for sale. Okay, which will come up. So they are not recognized. No, they are recognized. They flow through the income statement. That's why we call them FVPL. PL means income statement. Got it, everyone? They are a component of comprehensive income accumulated. No, they are not OCI. OCI is only for available for sale. See the question number 12. Financial asset classified as available for sale. What is the name for available for sale? It is FVOCI. That's why the unrealized gain and loss are reflected in shareholders' equity. They are not recognized. No, they are recognized. Do they flow through retained earnings, everyone? No, they are a component of accumulated OCI. They don't go through the income statement. They don't bypass, they don't go into the income statement. They directly bypass and go into OCI. That's why the name FVOCI. Now, a suggestion here, student need to remember the names. Held to maturity, which is next, is also called amortized cost. Amortized cost. Available for sale is also called FVOCI, and held for trading is called FVPL. The name itself gives you the answer. So, what about held to maturity, unrealized gain and loss? Guys, held to maturity are at amortized cost, so they are always recognized at the amortized cost. Therefore, there is no unrealized gain and loss, and hence they are not recognized at all. Everyone understood? Check, check, check. In my topic of balance sheet, I had mentioned this somewhere. Yes, it's not here. So, in somewhere in the balance sheet, where is it? Yep. See here. Amortized cost, nothing on the balance sheet. On the balance sheet, only amortized cost, no unrealized gain and loss. Understood? Clear? Okay, very important. These are the financial securities related questions are very, very, very crucial. Okay, now when I look at this question number 14, I want you to tell me the name. Okay, the US GAAP treatment of trading securities. What is trading securities in IFRS called as? Trading securities? Is it FVOCI or FVPL? Trading securities. FVPL. Correct. Is the same as IFRS treatment of fair value through profit loss. Many students ask me, sir, are these types of questions asked? Yes. Okay. Got it. These are all from the balance sheet topic. In the balance sheet topic, there is also mention of goodwill. Goodwill. By the way, goodwill is also discussed in long-lived asset or long-term assets. Guys, goodwill, which goodwill do we record? We record accounting goodwill, not the economic goodwill. What is accounting goodwill? Accounting goodwill only comes up when a company buys another company at a value higher than its fair value of net assets. So any extra amount that you paid is recognized as goodwill. For example, let's say a company's net asset value based on fair value is $100 million and you take over the company at $125 million. So that the extra 25 million is called goodwill. So balance sheet goodwill is described as amount by which the purchase price of an acquired firm exceeds its identifiable net assets. Yes, the extra amount. A is the correct answer. Intangible value a firm creates in excess? No. In excess of identifiable net asset? No. Balance sheet goodwill is accounting goodwill. It appears when you acquire another company and pay more than its net assets value. Are you with me? Not B. It is A. A. Those who have written B, it's not B, it's A, the extra amount that you pay. Value derived from expected future performance. Guys, what is this C? This is not actually accounting goodwill, the C part. This is actually economic goodwill. Economic goodwill, we don't record it on our balance sheet. Brand value of the company, employees' honesty, all of or employees' commitment, all of these are not accounting goodwill. Accounting goodwill, I'll repeat, only comes up when you take over another company and pay more than its fair value of net assets. Understood, everyone? I've trained many senior candidates and they also tell me, oh, is it not the same goodwill that is the company's goodwill brand value? No, that's not what we record in the financial statement. In financial statement, we record the goodwill only when you acquire another company at a higher valuation than its net assets. Clear? Now comes my favorite topic, that is cash flow. Of this, tell me what are the three cash flows? Tell me on the chat box. CFO, CFI, and the third one, CFF, right? Most of the times you are going to get question related to CFO. Why? Because CFO has two ways, direct method and indirect method. Okay. So most of the questions are going to be around that. Whether you use direct or indirect, the answer is going to be the same, right? Now below is the information of Yaira Inc. Correct? Total, what are the total net adjustment that the company would want to take to the net income? Means net income is already here. What are the additional adjustments that you need to do? And for that, guys, I am solving it using my way. If you have another way of doing it, you might not understand it because I don't do it mathematically. So, watch out the way I do it. Later on, you can practice it. Okay. Because CFO, to calculate CFO, I've spent so many hours on my recordings also. It's not 1, 2, 3. It's not like this. Many people do it mathematically, but it's not that way. Okay. First of all, what is a formula? Net income plus non-cash. So depreciation is what I will add. So 2 million will be added. And then we do the changes in working capital. Okay. In working capital, I want you to first understand from 17 to 18. So from this to this, how much is the chain? 3, 4, and 5. But we don't rely on this plus minus. We think from our point of view. Increase in current asset is an outflow, but decrease in current asset, accounts receivable is current asset, inventory is current asset, and accounts payable is current liability. What is happening to current asset? 25 to 22, it's reducing, right? So decrease in current asset, like you've sold it. So that's a cash inflow. Inventory has increased. That means you invested more in the inventory. So that's a outflow of cash. And accounts payable have increased. That means you didn't pay them. It's like borrowings. So that will also be considered as a cash inflow. Are you with me? So basically in your net income, what are the adjustments that you're going to do in the net income? Depreciation, you will add plus 3 minus 4 plus 5. Let me know the total adjustments that you're going to do. 5 plus 5, 10 minus 4, 6 plus 6. So you are going to add 6 million to the net income. Remember, they haven't asked you CFO. If they ask you CFO, it should be net income 20 plus 6, 26. But they haven't asked you CFO. They have asked you how much extra you need to add to the net income. That's the question. Total net adjustment that the company would make to the net income. Many people get confused. 20 is already the net income. The net extra is 6. Got it? Remember here, increase in current asset or decrease in current liability is a cash outflow. Check out the notes. And decrease in current asset and increase in current liability, it's a cash inflow. So we don't rely on their plus minus. This plus minus is a trap. Don't depend on that. This is the balance sheet plus minus. We need to think from the cash flow plus minus. Got it? Trust me, many students still don't know this. They do it in their own way. Sometimes they get the answer, they get excited. Wow, I got the answer. But the process is this. Clear? In 2018, a company using US GAAP made cash payment of 6 million for salaries, 2 million for interest, and 4 million for taxes. So this is already outflow. Okay. See, they've said cash paid. Okay. So these are all already outflows. Are you with me, everyone? Correct? Okay. So basically, how much has been paid? 6 million has been paid, right? Everyone check, 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 check. 6 million has been paid for salaries, 2 million for interest, and 4 million for income taxes. This is already my cash paid as an outflow. Okay. Additional information for the companies provided 2017 and 2018. Revenue is given to us, cost of goods sold, inventory, accounts receivable, accounts payable, based on the information the company's operating cash flow. Guys, first of all, am I going to use a direct method or indirect method? Can someone tell me? Are we going to use direct method or indirect method? Can someone tell me? Check, check, check. Yep. Okay. Yes. Direct or indirect? Go ahead, everyone. See, you need CFO, right? For CFO, if they give you net income, depreciation, then you can use the indirect method. If not, you have to use the direct method. Direct method. Everyone, in the direct method, what happens? You need to first calculate cash received from the customers, right? Correct. So that's called cash collected from customer, cash paid to suppliers, and then cash paid for all other things, right? Cash collected to customer requires revenue. How much is your revenue? 37 current year revenue. So plus 37 because revenue is an income, right? And then you need changes in accounts receivable and unearned revenue. Do you have unearned revenue? No, but you have accounts receivable. So this is from 17 to 18. So I'll write here, this is 2017. This is 2018. So you don't get confused. See guys, accounts receivable, how much is the change here? 3. But accounts receivable is going down. That's decrease in current asset. It's an inflow. So I will add 3. Got it, everyone? This is my cash collected from customers. There is no unearned revenue. So this is going to be plus 40. Cash paid to supplier is COGS, cost of goods sold, which is current year 16. So I will write minus 16. And then I need inventory and accounts payable. So inventory, how much is the change? 4. Accounts payable is 2. Now guys, 4 and 2 I write, but whether it's going to be plus or minus, you need to think from inflow outflow point of view. Cost inventory is increasing. That means you invested. So it's an outflow minus. Accounts payable is reducing, means you repaid. So that's also outflow minus. Therefore, minus 22. Understood? Correct? All this is done. And then rest, they've already told you. What are the rest things? These are cash payment for salaries, operating expense, interest, and taxes. So 6 plus 2 plus 4. So 6 plus 2 plus 4, that is minus 12. Isn't it? All of these are outflows. Clear, everyone? Got it? Everyone, check, check, check. Let me know what's your answer. This is going to be 34 minus. So you'll be left with plus 6. Plus 6. That is 6 million. These are CFA Institute's some of the questions, okay, which many students have never seen. They see, oh my God, where is this? This is in CFA Institute. Understood? Very interesting questions. Got it? Everyone? Correct? Let's do few more questions for cash flows, everyone in the class, right? I have put 3 more questions related to the cash flow because this, as per me, is very crucial topic. Everyone. Now, see this. Yaira Corp, a garden supply wholesaler, reported cost of goods sold for the year 80 million. Total assets were 55, including increase in inventory. Guys, cost of goods sold is 80. So minus 80. Increase in inventory, guys. Increase in current asset, it's an outflow. 5. Correct? And total liabilities increased by 45 million, including increase of 2 million in accounts payable. Guys, increase in current liability is actually a inflow. They are asking me cash paid by the company to the supplier. What is this called? This is direct method. Cash paid for supplier. What is the formula of cash paid for supplier? Minus COGS plus minus changes in two things: accounts payable and inventory. But the rule is the same. Increase in current asset or decrease in current liability, it's an outflow. Decrease in current asset and increase in current liability, it's an inflow. I've put a lot number of hours when I do this in the class, to the point that student get irritated, sir, when will this topic finish? Okay, trust me, student get irritated with that. But once you do that, you can solve any question. Okay, everyone. Now I have a question. Why is 45 million not added? Guys, because for cash paid for supplier, I need 3 things: cost of goods sold, inventory, and accounts payable only. I don't require other assets or liabilities. I require only this: inventory, accounts payable. Understood? So out of the total, I don't care about the total. I just need how much is inventory, how much is accounts payable. Clear? That's why I did not even mark it. Got it? So here the total is 85 and 2. This is going to be minus 83. I write it minus 83 because this is always an outflow. So you won't see minus in the numbers. Minus means it's an outflow. So cash paid to the supplier or operating expense or interest or taxes, all of these are outflows. So our answer is going to be C. 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 Don't think it from math point of view. If you think it is mathematics, no, you're making mistake. It's not mathematics. Clear? Inflow, outflow. You have to think from inflow, outflow. Next, KRD, a retailer of floral products, reported cost of goods sold. See again, cash paid by company to its suppliers. What are the 3 things you need? Cash paid for suppliers. Again, you need cost of goods sold, right? How much is cost of goods sold? 75. So I'll write minus 75. 2 more things you need. 2 more things: accounts payable and inventory. So total asset increased by 55. I don't care about that. Correct? But inventory declined by 6 million. So guys, inventory decline, decrease in current asset is a decrease in current asset is an inflow because you sold, right? Total liabilities increased by 45. Accounts payable increased by 2 million. Increase in current liability is also an inflow. Understood? So 75 negative plus 8, you will get minus 67. That means cash paid to supplier is 67 outflow. Understood, everyone? Correct? Right? The objective here is to tell you how to solve it. Of course, you will revise, do this again, then you'll be able to understand. But I've cherry picked these questions so that you know what length and breadth they can ask. Next one is pretty much easier. See, all of the questions that I show you were related to CFO because I think CFO is amazing. CFO is something that they frequently test. Okay. So let's see this. ABC Corp. Everyone with me? Check, 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 check. Out here? Yes. See, ABC Corp, a commodities trading company, reported interest expense of 19 million and taxes of 6. Interest payable increased by 3, taxes payable decreased by 4. How much cash did the company pay for interest and tax? Very interesting. This is cash paid for interest, cash paid for taxes. Now, guys, first of all, I will take the interest expense, that is minus 19, and taxes. How much is taxes? Uh, interest expense was 19 and taxes was -6. Now I'll apply the same rule of increase or decrease in current asset and current liability. First of all, they said interest payable increased by 3. So I'll write down here 3 and taxes by 4. Okay. The important question is whether this is going to be plus or minus. So again, apply the same rule. Interest payable, which is a current liability, increase in current liability. It's like you borrowed more. So that's a cash inflow. So if it's a cash inflow, add it. Increase in current liability, it's a cash inflow. Taxes payable decreased by 4 million. So when a taxes payable is also current liability. So when liability is reduced, that means you paid. So that's an outflow. So this will be -16 and this will be -10. Many students who've not done CFO, CFI, CFF through me, when I show them this is the way of actually doing it, suddenly they get surprised. Really? I didn't study like this. I studied some other method. So, yeah, clear? Understood? These are top questions from your cash flow. Remember, cash flow has two parts. One is your normal cash flow, and then the other part has relation to free cash flow. Understood? Free cash flow. So free cash flow has two parts, FCFF and FCFE. Okay. FCFF and FCFE. Now, if you see these two questions, they are asking me to given the following information. Okay, this is about still the cash flow, right? What adjustment to net income when calculating cash flow from operations? Okay, so we are still doing CFO. So we haven't reached to that method. So this 21 and 22 are also related to operating cash flows and all, right? Okay. What adjustment to net income? So net income is already there. We need to do adjustment. Now, this is what will make your practice firm. Increase in accounts payable. Accounts payable. This is current liability. Increase in current liability. It's a inflow. Sold one share. I don't need this. Paid dividend. I don't need this. Depreciation. Depreciation is a non-cash. Remember, in indirect method, we add the depreciation because our formula is net income plus non-cash. So depreciation will be added. And increase in inventory. Inventory is a current asset. Increase in current asset is an outflow. So I will do -20. So plus 25 plus 100 minus 20. This will give me 105. That should be added to the net income. Correct? Actually, cash flow was my weakest point when I did CFA. I got so worried by the way I created my own way of dealing with cash flow. I worked a lot hard and I created my own way. So you won't believe I actually solved all the cash flow questions wherever they are in the world. I solved all of them. And then I made up this method. So you might see me being able to do it faster because of practice. Of course, you can also, when you practice more, you will also catch up with the speed. Got it? Perfect. Yes, thank you. So thank you for the appreciation. Uh, See, what I'm trying to say is that my method is, I don't say my method is best, my method is bad. But what I'm trying to say that I've made this method because I myself as a student struggled a lot. So everything that you see, I've just recreated my own way. Okay. After doing more than 5,000 questions. You won't believe I had actually, I'd been to one very famous institute. Uh, they threatened me that we will remove you from the class because you're taking too much of time in teaching. So I was actually being penalized. So, one more lecture you take on cash flow, we will not give you additional lectures. I said, okay, let me start my own class. So this is what happens, from the professor's point of view. Anyways, use the following information to calculate cash flow from operations using indirect method. Again, starts from net income. So I have net income 12,000. I will use now, in this case, there is no addition. I'm actually going to use all the information, 12,000 net income. After that, I require what? Non-cash. So what is my non-cash? Depreciation. So I will add back depreciation 1,000. Correct? Right? Depreciation. Then I need to check if there is anything non-operating. If you check here, loss on sale of machinery, this is not related to operating. We are calculating operating cash flow, right? We are calculating operating cash flow. So loss from sale of machinery, is it operating? No, it is investing. So why is it there here? So we had subtracted the loss. We will add it back. Why? Because this is non-operating, correct? So I will add back the 500. Now, the rest of the thing, if you see, these are related to working capital. So increase in accounts receivable and accounts payable and income taxes payable. Repayment of bond is not a part of CFO. So exclude that. Increase in accounts receivable, increase in current asset is an outflow. Decrease in current liability is also an outflow. Increase in current liability, it's an inflow. So what I'll do is basically minus 2000 minus 1500 plus 500. Trust me, if you do this way, I wish I could say it openly without any violation. That perfect method I have. Unfortunately I can't say. CFA Institute says don't exaggerate. So I'm controlling 12,000 plus 1000 plus 500 minus 3500 plus 500. 10,500, 10,500. I can't say it, but my students can say if they really like it. Unfortunately, what happens as soon as the student pass, they disappear. They don't even recognize me. They should do. I wish and pray you all pass with highest percentage. And as soon as you pass, write down a good post for me. That's the entire reward. Thank you. Thank you. Clear, everyone? Okay, now we move to that second topic of cash flow, where you had FCFF, FCFE, and related to common size cash flow statement. Okay, so see this. Here, one of the appropriate method of preparing a common size cash flow statement. Common size cash flow statement are done using two ways. Either you convert all the numbers, divide by revenue, same like income statement, or you take cash outflow, divide by total cash outflow, cash inflow, divide by total cash inflow. Both ways. So is to show each line item of revenue and expense as a percentage. No, that's income statement. A is not the answer. On the cash flow statement as a percentage of net revenue, yes, you can use this. There are two ways you can use this. But what is wrong with C? If I'm using B, what is wrong with C? On the cash flow statement as a percentage of total cash outflow, no, 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 no. There is some error here that each cash outflow with total cash outflow and each cash inflow with total cash inflow. It's not that any cash flow divide by any cash flow. No, cash outflow divided by all the total cash outflow, cash inflow divided by all the total cash inflow. That's why C is wrong, because it says cash flows as a percentage of total cash outflow, all no, only outflow divided by outflow. That's why C is wrong. Which of the following method is appropriate for computing free cash flow? Now, guys, what is the free cash flow formula if you do it from the operating cash flow point of view? So it is CFO. I'll write down the formula. It is CFO. CFO itself has three things. Remember, CFO itself has three things. Net income plus non-cash, that is depreciation, minus your working capital changes. Okay. So this is your CFO. From this, subtract fixed capital, but you need to add interest 1 minus T. This is your free cash flow to the firm. If they had asked me FCFE, then instead of interest 1 minus T, I was supposed to write net borrowings. Here they asked me what is that you need to do for FCFF, FCFF. So I require three things: CFO, minus fixed capital investment because that's an outflow, and plus interest 1 minus T to add it back. So add operating cash flow, correct? A and B, right? To capex and deduct after tax interest, no. Add operating cash flow to after tax interest. After tax interest is added, correct? And deduct capex, that is fixed capital. So this is Right one, B. We don't deduct both. Are you with me? Check, check, check. Everyone. Now in the next ones, I have actually put up the question as to how to calculate FCFF. Everyone. So check out FCFF. Again, as I said, you require these three components: CFO, fixed capital, and interest 1 minus T. So here I have net income, depreciation, and accounts receivable, accounts payable. These are related to working capital. So if you do all these three, you will get CFO. CFO. So what is going to be my CFO? Net income 43.7 plus 4.2, and working capital increase in accounts receivable. Increase in current asset is a increase in current asset is an outflow. Decrease in accounts payable, that means you paid. So even this is an outflow. So I will minus what? 1.5, and I will do minus 2.3. This is going to be my operating cash flow. Can you calculate this? 43.7 plus 4.2 minus 1.5 minus 2.3. You will have 44.1. I would recommend you to store it. Store one. This is my first part, CFO. Now I need to check CAPEX. CAPEX. So CAPEX is inflow and outflow of property, plant, equipment, right? Sold is inflow, purchase is an outflow. So here, if you see CAPEX from this, so from in my FCFF calculation, my CFO is 44.1. Here, plus 15 and guys, plus 15 and minus 35. Can I say this is minus 20, isn't it? So minus 20. Do we have any information about interest 1 minus T here? No. That's it. So this is what your answer is. It should be 24.1. Unfortunately, they have not given 24.1. So the closest is what we choose. Got it? Everyone? Check, check, check. 24.1 is the accurate one. Can you try one more, everyone? Kunal Doshi is analyzing Yaira Corporation. Doshi gathers the following information: net cash provided by operating. So I already have my CFO 3,500, correct? Net cash used for fixed capital. So guys, fixed capital investment is 727. This is used. So used is an outflow, provided is an inflow. Understood? All these minor things, it's better if you read it carefully. Don't be in a hurry. But now for FCFF, I need plus interest 1 minus T. Now, very interesting question this is. They've given you cash paid for interest as 195. So I have 195. Anyways, I'm going to add this. Add 195. But I need into 1 minus tax. So what is my tax? They haven't given you the tax rate. They are very smart. Over smart they are. Income before tax, income tax expense, and net income. Now, guys, if you remember to calculate tax rate, tax is paid on before tax or after tax amount? Net income or before tax? The tax is paid on income before tax. Yes. So your 1540 that you're going to pay on before tax amount, that is 4,400. This will give you how much is your tax rate. 1540 divided by 4400. This is going to give you that your tax rate is 35%. Correct? So that's going to be your interest 1 minus T. So let's calculate how much is this. Minus 1 into 195. That is 126.75. 3,500 minus 727. You get exactly, if you do FCFF, you'll get 2899.75. 2899.75, of course, which is rounded off to 2,900. Got it? Everyone in the class? This is going to be our 126.75. Clear? Everyone? Till this point, all your cash flow related question. To be honest enough, if you have read my notes or if you have seen my videos, I tell the students that most of the students think that inventory, long-lived asset, long-term liability, tax is a problem. I tell them no. The first four topics, which is your foundation of financial statement, balance sheet, income statement, cash flow, student don't realize they have problem here. Understood? If this is strong, rest all is cakewalk. Got it? You should spend more time here to make your foundation strong. Clear? Everyone till this point? Check, check, check. Okay. Now, when it comes to inventory, LIFO, FIFO, weighted average, right? Okay. Write down of the value of inventory to its NRV, net realizable value, will have a positive effect on balance sheet. No, when you write down the inventory, the balance sheet value goes down. Income statement, no, write down is a loss. So even income statement goes down. But inventory turnover ratio, guys, yes. Why? Let me tell you. First of all, can someone tell me what is inventory turnover ratio? Inventory turnover ratio, very, very important, correct? It's cost of goods sold over inventory, isn't it? Over average inventory to be precise. Now, whenever there is a write down, what happens? Your inventory goes down, and because write down is a loss, your cost of goods sold increases. So actually, because of this, your inventory turnover ratio goes up. Now, it's a myth. It's a eyewash because in reality, you think, wow, my efficiency is increasing. But actually, it's not increasing because you're selling faster. It's just because your inventory's valuation has gone down. So, which ratio appears better because of write down? Inventory turnover. Balance sheet income statement value goes down. Got it? Right, right, right. Okay, check this. Next, like many technological companies, KRD Tools operates in environment of declining prices. Its reported profits will tend to be highest if its profit will be highest if its inventory using. See, normally we assume the prices are rising. If the prices are rising, LIFO COGS are bigger. So when the prices are rising, LIFO COGS are highest. But here they are saying prices are falling. So first of all, I want to know where on this planet Earth prices are falling. But still, since prices are falling, LIFO COGS will be the lowest, isn't it? So LIFO COGS will be the lowest. So therefore, I can say LIFO profit will be the highest, isn't it? Everyone, correct? Got it? Check, check, check. Guys, you're not answering. Don't feel shy. LIFO COGS are highest when the prices are increasing. So the profits are lowest. Here, LIFO COGS will be lowest because prices are going down. Are you there? Understood, everyone? Next, compared to using weighted average cost method, during a period when the prices are generally rising, which is naturally the case, the current ratio of a company using FIFO, see, you have to compare FIFO. FIFOs, first of all, current ratio is current asset over current liability. Remember FIFO, when prices are increasing, FIFO COGS are low and inventory is higher. FIFO inventory is highest. So since FIFO inventory is highest, FIFO's current assets are highest and therefore its current ratio is highest amongst the three, whether it's weighted average or LIFO. It's higher than both of them. So compared to all this current ratio, in current ratio terms, FIFO will be higher. Now, whether they give me weighted average or LIFO, my answer would still be the same. Understood, everyone? Confirm me if you understood this. Your knowledge of ratio is more important. Many students think, isn't there a question about ratios? They don't ask you ratio related ratio questions. They do. I can show you that as well. But in reality, the ratio questions are twisted with inventory and all. Understood? By the way, this current ratios, okay, the liquidity solvency ratios, these are liquidity and solvency ratios, right? Liquidity ratio is for less than 1 year, current asset, current liability. Solvency is long term, right? Everyone? Correct? Liquidity, solvency, everyone. But inventory turnover ratio, then your asset turnover ratio, receivables turnover ratio, these are efficiency ratio. So they are asking us, compared to company that uses FIFO during the periods of rising prices, a company that uses LIFO method will likely appear. See, anyone who uses LIFO, what happens? We just discussed there. For LIFO, liquid, efficient, and profitable. First of all, LIFO method, LIFO's COGS will be higher. So if the cost of goods sold, COGS means cost of goods sold, sorry. So if cost of goods sold are higher, its profitability will be low. Its profitability will not be more, right? Most likely will appear more profitable. No. So C is definitely not the answer for LIFO. Liquidity, is it, see, LIFO companies, cost of goods sold are higher. Its inventory, ending inventory is low. So its liquidity ratio, you can think of liquidity ratio as current ratio, which we just saw. So liquidity ratio will also be low, but it will appear more efficient because of the inventory turnover ratio, which is cost of goods sold over, over cost of goods sold over inventory. Now, what happens here? LIFO companies' COGS are higher, ending inventory is low. So the ratio looks good. But as I said, it's an eyewash. It's not looking good because you're selling faster. It's just the technical issue here. Clear? Everyone? Perfect. Very important. By the way, inventory turnover and all are called efficiency ratios. So see, indirectly, they are asking you whether you know the headers, the name of the ratios also or not. Understood? Profitability ratios are gross profit margin, net profit margin, return on equity, and so on. Okay. Compared to using FIFO method for inventory during periods of rising prices, a company that uses LIFO method is most likely to report higher. See, LIFO, what is higher LIFO? Everyone, come on, this is very easy. Everyone should be able to answer. Net income, cost of sales, which is also called cost of goods sold, or income taxes. What is going to be higher for a LIFO company when prices are rising? Everyone, check. B, COGS will be higher. Easy, clear, got it. Now we go to the inventory. Under the inventory valuation, inventory measurement, there are two ways: lower of cost or NRV. This is used for which companies? Lower of cost or NRV. This is used for non-LIFO companies. And this is only for LIFO. Remember, LIFO is only allowed in US GAAP. So lower of cost or NRV for non-LIFO companies and lower of cost or market for LIFO companies. So they're asking a company purchase inventory at this price. So this is cost 600,000. On December, that is at the end of the year, inventory had an NRV of 550,000. This is my NRV. So, and a replacement fine, which is okay. What would be the carrying value of the inventory? Now, when they say lower of cost or NRV, should I take 600,000 or 550? I will go for 550. The only option here is C, isn't it? So actually my answer is done, but still we will see how to find lower of cost or market. Now this is basically for US GAAP LIFO. Here lower of cost or market, or sometimes we call it as a replacement cost. Okay. So lower of cost, what is my cost here, guys? My cost is 600,000, and market replacement cost, they've given me 525,000. Actually, market replacement cost is in US GAAP, LIFO, there is a range, upper limit and lower limit. Upper limit is NRV, so it cannot be higher than NRV, and lower limit is NRV minus normal profit margin. Many students struggle with this. They're not able to remember it. So NRV is what? NRV is 550,000, correct? And NRV minus normal profit margin, they've said 525,000 is actually NRV minus normal profit margin. So they've given this value. Now, your value should neither be more than this nor should be lesser than this. This is a limit. They've given you replacement of 525,000. So can I take it or not? Can I take that as a replacement? Yes, because it is within the limit. If they had given me replacement cost of 510,000, Can I take 510? No, the minimum I can take is 525. If they give me replacement about, let's say 575, can I take 575? No, maximum I can take is 550. But here they give me 525, which is okay in my limits. So my market replacement cost is a range here. You have to test it whether it falls in the range. Now I have to take lower of both, which is 600 and 525. Which one is lower? 525. So I go with that. Of course, we already got the answer because the only choice of 550 is C. But assuming if you had two choice, then we are prepared for that as well. Clear? Many students have issue with this inventory measurement, but yes, clear. Very important topic, inventory. Okay, we have one more question. Assuming beginning inventory levels are zero, so there is nothing beginning. Everything is purchased and sales. Inventory levels increase during the years and prices have been stable. Guys, when the prices are stable, does it matter whether you use LIFO, FIFO or weighted average? Does it matter when the prices are stable? No, it doesn't matter. When the prices are increasing or decreasing, the numbers are different. When the prices are stable, it doesn't matter whether you use LIFO, FIFO or anything, right? So the COGS will be same whether you use LIFO, FIFO or even weighted average. Why? Because of that one statement, prices are stable. If they are not, if they are increasing or decreasing, then the relationship is different. Are you with me? Understood? Clear? Got it? Check, check, check. Yes. Okay. Now you will see questions related to the topic of long-lived asset. Long-lived asset. Long-lived asset. Long-lived asset is property, plant, equipment, right? Tangibles, intangibles. Correct? Okay. Now, these three questions are based on this information. Okay. Analyst is studying the impairment of manufacturing equipment. Trust me, impairment is something very high chance of, I assume, being asked. Now, for impairment, I'll actually show you from my notes, but because I know most of the students actually struggle with impairment a lot. So let me go to the impairment process. See, in IFRS, you have to compare carrying value and recoverable amount. In US GAAP, you have to come, it's a two-step process. So first I'll have to check whether it's IFRS or US GAAP. They said it's a UK based company. So which should it be using as IFRS or US GAAP? It is using IFRS. So in IFRS, it is what? Carrying value, you need to compare with the recoverable amount. So carrying value, when is the impairment? Impairment condition is that if your carrying value is greater than the recoverable amount. But the question is, what is recoverable amount? So first of all, let's check what is the carrying value. Carrying value here is net carrying value 19.1 million. Now, recoverable amount, what is the minimum that you will recover? Okay, recoverable amount is actually higher of two things. It is maximization of two things. Fair value minus cost of selling, that is similar to NRV. So that is 16.8 minus 0.8. So I will say it is 16.8 minus 0.8, 16 million. Or value in use if you plan to continue to use. Imagine you have a car. If you plan to continue to use, you'll get 14.5. But if you sell it off right now, you'll get 16. So which one you will choose? You will always choose the one which gives you higher value. That higher value is 16. So my recoverable amount should be higher of both. Are you with me? And then the difference between both is going to be my impairment loss because the recoverable amount has gone below. Understood? Correct? So 19.1 minus 16. That's going to be my impairment loss, which is basically going to be 3.1 million. Understood, everyone? Very important. Clear? See here, recoverable amount is higher of fair value minus selling cost or value in use, which is actually present value of cash flows, future cash flows, which they will provide. Correct, everyone? Very interesting, right? Under IFRS, an impairment loss on property, plant, and equipment is measured as the excess of the carrying amount. We just did. Carrying amount over what? What is the term that we used? Carrying amount over recoverable amount, not the fair value. Recoverable amount. Understood, everyone? B. Impairment of intangible asset with finite life. First of all, can I impair intangible asset with finite life? Yes. Right? Now, guys, whenever you do impairment on the balance sheet, your asset value goes down. And on the income statement, since you book a loss, impairment loss, what happens? Your income statement value also gets affected. So they are saying it affects only balance sheet, only income statement. No, it affects both. Am I correct? Clear? Okay. Now, here is the question related to the depreciation. Remember, in depreciation, you can actually find out the average age, useful life, and remaining useful life. Here, they have asked what is the average age of the firm's PPE. So what is average age? Average age, how do I get to know? I get to know average age by the total depreciation till date, which is accumulated depreciation divided by the depreciation expense. For example, let's say till date, I've depreciated 40,000 and every year there is 10,000 depreciation. So basically my average age of the asset is 4 years. So here the question is, can be estimated by dividing. What do I divide? Dividing the accumulated depreciation by depreciation expense. So answer is pretty much easy. A. Correct? When they say gross, this is going to give you total useful life. And when they give you net, this is going to be remaining life. Okay, I'm just writing it for your reference. Clear? We are looking for average age. That is the age till now. Got it? Clear? Next, which of these intangible asset is most likely to be amortized? Remember, only identifiable intangibles with finite life can be amortized. Okay. There are three types of intangibles. Either they are created internally, they are purchased like any other asset, or you acquire them during business combination like goodwill. So only the one which you have purchased, correct? Purchased, those are the ones we do what? We do what? Capitalize, and therefore they are expensed. So purchase franchisee right with useful life of 2 years. Should I amortize this or not? Yes, I can amortize. It's like buying an asset. I bought an asset, right, with a useful life, limited life, I can amortize. But what about B? Internally developed trademark. See, whenever you are working on it, internally developed expenses related to internally developed, right? Unless and until it's software for sale or it's research and development. Apart from that, it is always expensed. So whatever is expense cannot be amortized. Got it? Purchase patent that will expire in the current year. Since it's going to be expiring, you don't need to amortize it. Okay, because there's no future benefit. So if there's no future benefit, no need to amortize. Got it? Clear? So A is the answer. The amortized cost of trademark least likely to appear on the firm's balance sheet if the trademark was, see, 38 and 39 are connected. If the trademark was developed internally, I told you, developed internally are expensed. So amortized cost of the trademark least likely to appear on the firm's balance sheet. Is it going to appear on the firm's balance sheet? No, it is going to be in the income statement. Obtained in acquisition or purchase, yes, these two you capitalize. So whenever you capitalize, of course, that is going to be reflected on the balance sheet. But when you expense, it's in the income statement. Clear? 3 years ago, company purchased equipment for a process used in production for 3 million. At the end of the last year, company determined the fair value of the equipment was greater than book value. Guys, In US GAAP, you use the cost model. So even if the fair value is higher, doesn't matter. But in IFRS, you have two options. You can either use cost model or fair value model. Okay. Now, again, this is not there in the Schweizer I saw. It's in the prerequisite, but in my notes, it's there. No impairment loss have been recognized. Okay, no problem. So basically, this is going to be my purchased an equipment. So this is going to be my book value. They said that currently the fair value is higher, right? Assuming KRD follows IFRS, okay, what is the impact on the total asset turnover and on return on equity? Guys, what is total asset turnover? Total asset turnover ratio is sales over total assets. Sales over total assets, correct? And they said return on equity. Return on equity, guys, my return on equity is net income over total equity. Okay. Now, let me tell you what is the situation here? They've asked me what is going to be the impact on these ratios on which total asset turnover and return on equity, reporting the value of equipment on the balance sheet at fair value. Guys, what has happened? The fair value is higher. In my case here, if the company is reporting fair value, which is only in IFRS, the fair value is greater than the book value. So when this happens, the balance sheet value, the asset value increases, and the increase is not recorded in the income statement. Yes, it is directly recorded in the equity account called as revaluation surplus. It's recorded in the equity account directly as revaluation surplus. Now, many students don't know this because they have not put in the notes. It's all in the prerequisite. So I have pulled out what is that they are going to probably ask, or that is what they ask in their notes or questions. So does it go into the net income? No, but because of this, the equity value increases. So in ROE, the equity value increases. In asset turnover ratio, the total asset increases. Since the denominators of both are increasing, what's going to happen? Both the ratios will fall. Remember, it doesn't go into the net income. Why? Because it directly goes into the retained earnings. So it doesn't go into the net income. Otherwise, net income would also have increased, right? Therefore, both the ratios will go down. Understood? Very important. Clear? Right, everyone? Okay. Now you see these questions related to stock options, lease, okay, lease. All of these are questions from your long-term liabilities. Got it, everyone? Let's do that. Which of the following potential drawbacks of compensating employees with stock option? Guys, when you give employee stock option, they might either take too much of risk in terms of greed to get more valuation, or they may become too much conservative if majority of their wealth is locked in shares. So they might become too conservative or too risk averse or too much risk seeking. So which of the following is a potential drawback, everyone? The grant may make employees adverse to risk, or may seek more risk, or both. Which one? Which one, guys? Yes, they will probably both are possible, right? Clear? Beginning with fiscal year 2019, what happened is that there was a new edition of the lease, where lease with term longer than 1 year. See, when I say lease is reported on the balance sheet as a liability only if they are greater than 1 year. Less than 1 year are not reported on the balance sheet, they are expensed. So leases report to right of use of asset and lease liability on the balance sheet, right? So starting 2019, what has happened is that IFRS, US GAAP both have almost merged all their treatment related to lease. So whether it's a finance or operating lease, any lease which is greater than 1 year will report both. The lesser is going to give the asset to the lessee. So the lessee will report an asset and liability both. Asset is right of use of asset, and liability is the lease liability that he's supposed to pay. So both, whether it's a finance or an operating lease, for both of them, you will record an asset, which is called right of use of asset, and a liability called lease payables or lease liability. Both are recorded. This is recorded in asset. This is recorded in your liabilities. Correct? Whichever leases, it doesn't matter. For a lesser is the one who is going to give the asset, right? Leased asset appears on the balance sheet and continues to be depreciated. Guys, in finance lease, the asset eventually goes to the lessee. But in operating lease, the asset still remains in the books of the lessor. So lessor is paying depreciation on it. Got it? So in which lease? In operating lease, the asset still remains with the lessor, isn't it? So this is the situation only in operating lease, not in any other type of lease. In finance lease, the asset eventually goes to the lessee. So it's the lessee's responsibility. In operating lease, the asset is going to be with the lessor only. So the lessor is going to be responsible for depreciation and other things. Clear? Compared with finance lease, why do people go for operating lease? Because you don't have to pay down payment. Like in finance lease, you don't have to borrow. Your not enough of the money is blocked, isn't it? So operating lease, in general life, whenever we rent a property, actually it's an operating lease. So operating lease is similar to renting because you're not going to be the owner of the asset. Correct? Right? Perfect. Now comes one more topic which many students have an issue with, that is taxes. DTA, DTL, DTA, DTL. Correct? Okay. So this is all about taxes. In the current year, company has a carrying amount of 3.5 million and a tax base. Now, those who've seen my lectures, okay, they know how do I process this. Carrying value is as per financial reporting and tax base is as per tax reporting. Your focus is on tax reporting. In tax reporting, why is that tax base higher? Is it because I'm charging more depreciation or less depreciation relatively? See, the carrying amount is lower because you're charging more depreciation, right? Tax base value is higher. How come your balance sheet value of tax base is higher? Because you're charging less depreciation now, isn't it? Guys, less depreciation means more profits. More profits means more taxes now, less tax in the future. So if this is to reverse, this less taxes in the future, is it a benefit or not? It's a benefit. So anything which is going to give you benefit in the future is a DTA. It's a DTA. Understood? How do I process it? Right now, I'm paying more depreciation or less depreciation because my tax base is higher, my depreciation is less. Maybe you're using SLM depreciation for tax purpose. So that's why your depreciation is less compared to double declining in the initial years. So because your depreciation is less, your profits are more. More profits, more taxes now, lesser taxes in the future. Therefore, it's a DTA because you're going to get benefit in the future. Clear? But always remember, you record DTA or DTL only if it's a temporary difference or permanent difference. Only if it's a temporary difference and it is expected to reverse. But look at this question. Company received 500,000 of tax credit from the recent installation of solar panels by government that will directly reduce their taxes. Guys, tell me first of all, is this a permanent difference or a temporary difference? Tax credit or any tax discount that you, because you opened a company in a special economic zone or a free zone, right? These are permanent differences. These differences will always remain between tax reporting and financial reporting. Anything which is like tax credit, which is penalty, these are permanent differences. Permanent differences. Permanent differences. Do we record a DT or DTL? No. Permanent difference is no DTA, no DTL. Understood? Whenever there is a permanent difference, you cannot record a DTA or DTL. DTA or DTL is only when there is a temporary difference. Are you with me? Clear? Tax credit, tax holidays for opening a company in free zone, or fines or penalties charged by the authority which are not tax deductible. These are permanent differences. Got it? A firm uses accelerated depreciation for tax purpose. So for tax purpose, guys, for tax purpose, for tax, my depreciation is higher, correct? Higher depreciation means my profits and taxes will be lower, isn't it? Lower now, more in the future. So this is going to be my DT. This is going to be my DTL, isn't it? So if a firm uses accelerated depreciation for tax and SLM for financial reporting, which of the following is least likely? First of all, is it a permanent difference or a temporary difference? Is it a permanent or a temporary difference? It's a temporary difference, isn't it? And this will result in a DTL. So permanent difference will result, no, this is not the answer. I mean, this is not the situation, right? That's what is least likely. Least likely means you're looking for the wrong answer. A temporary difference, correct? And income tax expense will be greater than taxes payable. Yes, taxes payable right now will be less because my profits are less, and therefore we call it as a DTL. But it's not a permanent difference. It's a temporary difference. Got it? Clear? Very interesting. Understood? Also, one more thing I have seen, very important. Tax loss carry forward. What is tax loss carry forward? Right now, you have a loss which you can use it to set off your tax payable in the future. So that's a benefit. Remember, tax loss carry forward is always a DTA. Without a doubt, it's always a DTA. So it's best described as a net taxable loss that can be used to reduce the taxable income in the future. True. Understood? Correct. Those who have tax background, for them, it might be very easy. Correct? Difference? No. Got it, everyone? Now, if you notice the last three readings of your FSA, they are financial reporting quality, financial statement ratios, and financial statement modeling. Okay. Of that, the financial reporting quality is very important because it talks about reporting quality and earnings quality. Reporting quality means is your report in compliance with the GAAP in the accounting standard? Is it having all the information, right? Earnings quality is whether the earnings are sustainable, means consistent, and whether they are enough to pay the capital providers, that is adequate. So earnings quality talks about sustainability of earnings. Reporting quality is more related to corporate governance. It tells whether the company's financial report has enough information and it is transparent and it is in compliance. So when they say sustainable earnings and adequate return, that is related to earnings quality. Reporting quality is whether the reports have relevant information. Understood? But low quality earnings, when they talk about earnings, when do I say earnings are of low quality? See, loss is not a problem, but consistent loss is a problem. Understood? Low quality financial reporting, no. Companies' activities which are unsustainable. Yes, whenever the company is making profits which are unsustainable, that means low quality earnings. Everyone with me? Information that is not faithfully, this is about financial reporting. See, A and C are about financial reporting quality, not earnings quality. Got it? 51 is my favorite. I want you all to try. There are three reasons why managers do low quality report: motivation, greed, opportunity because of weak control, and rationalization. What is rationalization? Oh, everyone is doing it, so why not me? So see, which of the following condition best explains why a manager is obtaining legal, accounting, board level approval prior to issuing low quality report? The manager is just checking, I won't get caught, right? So is it motivation? Is it opportunity? Or is it rationalization? Which one? Very interesting. Yes, answer everyone. Rationalization, right? You're trying to justify your choice. Whenever you try to justify your choice, that is rationalization. See, if it's about greed or fear, you're going to get highly incentivized. Then motivation. Opportunities when there is the board lacks oversight. All of these are opportunity, weak corporate governance. But rationalization is when you're just trying to confirm that, I can justify my wrongdoing. That's rationalization. Clear? Bias in revenue recognition. See, revenue recognition, what do people do in revenue recognition? They try to push more revenue. Would least likely be suspected. So you have to detect which is not a warning sign. Okay. First of all, firm engages in barter. Is that a warning sign or not? Barter. What is barter? So instead of cash transaction, I give you some goods and take some goods. This is one of the ways of bypassing. So that's a red flag, isn't it? Reported revenue is higher than previous quarter. Nothing wrong in it, right? This is not a suspicion thing. Revenue increasing, that's not anything wrong. Revenue is recognized before goods are shipped. This is quite aggressive, right? You're trying to push revenue. So which one is not an issue? Which one is not an issue, everyone? Everyone, A, B, or C? B is not an issue. Barter or recognizing early revenue, that are red flags. They are asking which one is not. Clear? You also need to read the questions carefully. Got it? In comparison to companies' financial results to other peer companies. See, when you're comparing your companies to the peer, what do we call it as? This is also in equity. What do we call it as? When you're comparing your company with the peer group, we call it as cross-sectional analysis. But when you compare your company with the previous year, it's called time series. Time series. Common size is when you convert them into some percentage. Got it? This is basically, these are questions related to, now you are moving towards ratios and financial statement modeling and so on. Correct? Now see this. An analyst observes a decrease in company's inventory turnover. I'll write inventory turnover is what? Inventory turnover is cost of goods sold over inventory. So why is inventory turnover reducing? Either because the COGS are going down or because the inventory is going up. Okay. Which of the following would most likely explain the trend? Very interesting. Company installed a new inventory management system allowing more efficient inventory. Guys, if the inventory management is more efficient, it should increase the inventory turnover, right? Not reduce. They are asking which one is going to make it reduce, which one is going to decrease. So A is not the answer. Am I correct? Everyone? Look at B. Due to problems with obsolete inventory means inventory that is wasted. Last year, the company wrote off large amount of inventory. See, guys, when you write off inventory, your inventory goes down. And whenever your inventory goes down, ironically, your inventory turnover ratio will increase. We are looking for what will cause your inventory turnover ratio to go down. They are asking decrease of inventory turnover. Which one? A and B, definitely not. So C is the answer. Why? Let me tell you. Company installed a new inventory management but experienced some operational difficulties resulting in duplicate order being placed with supplier. Now, due to this, what will happen? Your inventory is counted double. So your inventory counting has doubled. So if your inventory is higher, what will happen to your turnover ratio? Inventory turnover ratio, the denominator is higher. Your inventory turnover ratio will go down. So which one will cause your turnover ratio to go down? It's situation C. I always recommend student to write down the ratio and check one by one, the numerator component and denominator. Got it? Clear? There is one more analytical question related to it. Very interesting. Which of the following best explain an increase in receivable turnover? Guys, what is receivable turnover? Receivable turnover is credit sales or simply sales or revenue over receivables, accounts receivable. Now, guys, again, see the way I do it. So increase in receivables turnover can be either if your revenue is increasing or your receivables should decrease. Only then the ratio will increase, isn't it? So you have to check all the choices and compare. Company adopted new credit policy last year and began offering more credit to customers with weaker histories. Now this will cause your receivables to increase, isn't it? You're giving more credit. So is this going to increase your receivables turnover? No. Understood? Next, due to problems with error of old credit scoring system, the company has accumulated a substantial amount of uncollectible accounts and wrote off large amount of receivables. Now, due to this, your accounts receivable will go down because you wrote off. When you do that, your receivables turnover will increase. So as of now, this looks like a right choice. But let's see. To match the terms offered by the closest competitor, the company adopted a new term where instead of now you will be paying in 30 days rather than 50. So again, people are going to pay late. So your receivables will actually increase. So your turnover ratio will not increase. It will go down. So therefore, the only choice is B. Understood how to tackle this? Again, the technique is write down the ratio, check one by one. What is increasing, what is supposed to increase, decrease, and check that way. Clear? Next. Okay. Now, they've given you ROE, ROA, and asset turnover. First of all, what is ROE? ROE is net income over total equity. ROA is net income over total assets. And asset turnover ratio is sales over total assets. Correct? 1, 2, 3. But actually, if you notice in the Dupont, you can actually connect ROE with something else. So what is ROE? See, check here. ROE under the Dupont, I'm sure ma'am can tell me from Ether. Dupont is your competitor, right? Here it is. Got it? Your competitor is here. So ROE. Guys, Dupont ROE formula. See, let me break down. Dupont ROE is net income over, let's say if I do sales, this is going to be my net profit margin. Then if I do sales over total assets, this is going to be my asset turnover ratio into financial leverage, which is total asset over total equity, that is into financial leverage. This is going to be my Dupont ROE. Got it? But if you notice here one interesting thing, that ROE, if you check the first two components, so net income over sales into sales over total assets, so you can actually also write ROE as net income over total asset, that is ROA into financial leverage. So both are possible. ROE can be broken down into this as well as this. I'm just writing all the varieties. Now they are asking me, based on the information, most appropriate conclusion is that over the period, what has happened from FY 13 to 15. Now check it. What has happened to your ROE? Your ROE has gone up. What can be the reason? Either your ROE is going up or financial leverage is going up. Correct? But if you see, your ROA is going down. So definitely, what is the reason that your ROE is going up? It has to be due to financial leverage, isn't it? And why is your ROA going down? Either because your profit margins are going down or your asset turnover is going down. Either of the reason. Am I correct? Check it. So the conclusion will be, now if I said that the asset turnover is going down or net profit margin is going down, but I see the asset turnover is increasing. So guys, what is the only reason that your ROA is going down? Can you tell me? Your ROA is going down because your net profit margin in this case is going down because asset turnover ratio is increasing. So that is not to be blamed. So the only reason your ROE is going down or your performance is, your only reason your ROE is increasing is not because of ROA, but because of financial leverage. Within the ROA, can I say your asset turnover is increasing, but net profit margin might not be. That's why ROA is going down. So what will be my conclusion? Net profit margin, financial leverage, both are decreasing? No. Net profit margin, financial leverage, both are increasing? No. Net profit margin is decreasing, correct? But financial leverage has increased. Yes. Understood. In fact, I can say net profit margin is, I can write the conclusion. Net profit margin is going down, right? Asset turnover is increasing. Financial leverage is also increasing. Very, very important question. I love this question. It, touches all the nerves of your brain. Understood? Okay. Analyst is trying to mitigate representative bias. See, there are behavioral finance. If you see, it's asked many times in the syllabus. This is, by the way, related to financial modeling, that when an analyst is modeling, what type of biases the analyst can consider. Representative bias is where the analyst is, stuck in the past. The analyst is using past information. So it is a tendency of the analyst is to, classify the data based on past information, based on some representation, based on some base rate. That's what it's in the analyst head. It's more like conservatism. So representativeness is also more like conservativeness bias, where the analyst is stuck in the past. So would most likely, how to break the barriers of the past. Perform scenario analysis. Consider both inside and outside view. Yes, you should take outside opinion also, because you might be stuck in some specific bias, a representative number. So it's better you take an alternate opinion. Got it? Use flexible models with few independent variables. No, that will still keep you in the same issue. So it's better you take inside view, which is A and B. Fine, you can do performance analysis, you can do different modeling, but you also need to take outside opinion or outside view, because you're probably stuck in the same numbers. Understood? So performing scenario analysis, right? It will help you mitigate other biases like overconfidence bias, right? That will make you more flexible. But taking an outside view, that will probably help you get rid of something that you are not able to trace. Got it? The earnings forecast of a firm is most likely to be optimistic if the industry has Michael Porter's five forces. Remember, what are the five forces? When is the earnings potential optimistic? When the threat of substitute is high? No. Bargaining power of supplier? Yes, it has to be low. They should not be able to dominate me, correct? Barriers to entry are low. Anyone will enter. That's not a good news. So when will the profitability be higher? When the bargaining power of suppliers or buyer is low, when the threat of substitute is less, there are no enough substitute, the entry barriers are difficult, right? All of these will make my profitability stronger. Got it? One question which is very important and you will see very frequently probably is that when an analyst selects how much time they should, how much time data or they should forecast. So if it's a cyclical company, which of the following is most appropriate forecast time? See, there are various ways. Either you can use a random 4-year, 5-year period. You can use what your manager says. But if it's a cyclical company, then you have to use the midpoint of the business cycle. So here, if it's a cyclical company, until the middle of the business cycle or midpoint of the business cycle, there is no criteria like two full business cycle. No, midpoint of the business cycle for cyclical companies. Understood? That is the duration you should use to forecast. Got it? Next, analyst is developing a set of sales-based pro forma financial statements. So you're forecasting based on sales and states the following: statement 1, statement 2. Cost of goods sold will always grow at the same rate as sales. Guys, cost of goods sold has fixed as well as variable cost. Variable cost, of course, goes with sales. But can I say the same for fixed cost also? No. So statement number 1 is wrong. Am I correct? Statement number two, selling general and admin grows with sales. Now see, selling expense, yes, there's like commission, they go ahead with sales. Now, I have an opinion here. See, first is definitely wrong because cost of goods sold as fixed and variable. So first is definitely wrong. Now, if you look at the choices, which of the one is correct? So both statement one and two, wherever there is one, that is definitely not the choice. But if you see here, then the only choice left for me is statement number two. Now, statement number two also I have a problem. What is the problem? I'll tell you. Selling, general and admin. Out of this, the selling expenses goes with sale, but admin expenses generally doesn't go with sales. So if I were the one who probably would set up a question, right? I would be putting up the choice. If both are wrong, if both are wrong statement, then I would have chosen that because not all SG&A are dependent on sales. Got it? But since here the choices are tricky, we choose statement two. Clear? Everyone? Understood? I've tried to cover maximum varieties possible in this plethora of examples. I hoped you've liked it, you've enjoyed it. Do this after you revise it. Okay, once you revise it, practice this. Got it? Thank you so much. Yes. All right. Okay. FSA is lonely, but don't worry. It's doable. Yes.